play around with magic internet money? No one cared. Nobody cared. When hundreds of billions of dollars left the banking industry to go into crypto, people cared. And those people now are using regulation, quote unquote, any regulation, right? They're not actually using regulation. They're using enforcement. There's a big difference. They are manufacturing, reverse engineering charges against people. And it's so insane, right? It's okay, here are the rules. And then you play by the rules. And then ex post, a year, 2 years later, they say, well, yeah, okay, you played by the rules. But here's the thing. We didn't mean those were the rules. These are actually the rules. And therefore you violated the rule. There's a day in the future where exchanges are less necessary, when we can have a pure DeFi or a pure Bitcoin world. We're not there, not even close, but someday. So in the interim, we need some viable exchanges. And
Mark Yusko is an American investor and hedge fund manager. He's the founder, chief investment officer, and managing director of Morgan Creek Capital Management. According to Yusko, in case of crypto, regulators are coming down with an iron fist. In addition to stablecoins and staking protocols, the SEC is reportedly eyeing qualified custodians in its regulatory guidance and enforcement actions. Before going further in this video, make sure to hit the subscribe button below for more recent updates. According to Bloomberg, the SEC is working on a proposal that would make it difficult for crypto companies to serve as qualified custodians on behalf of clients. Financial regulators worldwide have hinted that their regulatory stance is set to toughen, but to what extent and how effective regulation will be remains uncertain. Some people believe that crypto companies will remain because there will be a willingness to retain competition in the market. Given the creativity of the creators of crypto coins, it is likely that cryptocurrencies with specific features will emerge after the launch of CBDCs to appeal to consumers and investors.
You look around at what is happening, and I think you were one of the first to bring this number out to people's attention. Was this persistent bubble, I'll call it, of quote unquote savings post the stimulus checks. And while it had been cut in half, it went from 2 trillion down to 800 billion, there were still 800 billion on consumer balance sheets. And so everybody's crowing about the retail sales number earlier this week. And, oh, it was such a great number. I'm like, okay, first of all, we had the warmest January in like a long time. I don't know exactly how long, but it was decades, like many, many decades. And it's not like it was super warm, like global warming warm, but it was warmer than average. And we didn't have any snow. I mean, we got no snow in North Carolina. I mean, not that we get a lot anyway.
Very mild winter in New York too.
Yeah, we got none. And because of that, they still, I just don't understand. They're supposed to seasonally adjust. And again, you got a lot of PhDs working on this stuff, and they never seem to get it right. And so first quarter always is wonky because it's weather impacted. And I would think they would have models at this point that would seasonally adjust correctly, but they don't. Anyway, so retail sales looked really good. If retail sales were up, whatever it was, 6 point something, and inflation was 6.4, we have negative retail sales growth, right? And that's not what we report. We report a big number. Like, okay, fine. You can delude yourself into thinking that everything's great.
Advanced retail sales for the month increased 3% compared with expectations for a rise of 1.9%. On a year-over-year basis, retail sales increased 6.4%, which was exactly in line with the Consumer Price Index move reported Tuesday. According to experts, the monthly reports on industrial production, retail sales, and jobs were generally better than expected and point to a pickup in economic activity in early 2023 after a soft patch in late 2022. The Fed will read recent activity reports as supporting plans for additional interest rate increases in the first half of this year. The data comes as the Federal Reserve is grappling with rising prices that appear to be abating, but are still well ahead of the central bank's 2% annual target.
From the beginning of the year to a few days ago, basically the terminal rate was falling. The expectation of the terminal rate was falling. Everyone was convinced the pivot was here. And we had two things that are causing, or that caused, again, past tense, caused one of the great melt ups of recent memory in January and the first, call it 10 days of February, which was, China and the Bank of Japan, my buddy, and now he's outgoing. I mean, crazy Kuroda-san, the sun is going to set on crazy Kuroda-san. They just elected a new central bank head, and it's just very sad. But Kuroda-san unleashed a Kuroda tsunami, the largest increase in money supply growth in his tenure, which is saying something. And the stat that I just love is in 4 days, I think it was December, he reversed all of the QT that the EU and the US did in 2022. Yeah. So in 4 days, okay. Then on top of that, right, as great as that tsunami was, heading towards our shores, China, basically the PBOC said, Kuroda-san, child's play. Trillion with a T, a trillion of new liquidity. And they've now said they're going to do 3 of those babies. Now, in 2016, they saved us from recession globally. Remember when oil prices at $26 and everybody thought the world was ending, and they stepped up and printed 4 trillion and saved the world. So they're trying again. And all of that liquidity came crashing into Silicon Valley, West Coast on January 1st, and caused the greatest short covering in history, right? In a 12-day period, more shorts were covered than any other time. And so we had this massive melt up, but all the short covering is over. And so what you've seen in the past couple of days is, okay, this good news is bad news. Okay, things are hotter, like literally hotter. January was hot. And the market's going down. So I think what you're going to see is kind of a gravity effect taken over.
According to pricing and derivatives markets, traders expect the ECB to hike rates to rise to around 3.5% in late summer, from 2.5% now. As the market is pricing a higher terminal rate, the market is also pricing higher cuts of 25 or 50 basis points at the end of the year. Despite the dollar rising last week, recent news suggests that the global economy is still on solid footing, which should eventually prove corrosive for the safe haven dollar. Hence, a big part of the dollar correction is equally attributable to a market that has moved far too fast. Ultimately, the improving global economic backdrop should see the dollar weaker during 2023. Still, bear traps will line the path given the still difficult road for Fed policymakers trying to slow the economy just enough to bring inflation back to target, where U.S. economic data and Fed speak will be the source of bullish USD shocks until the next month's major U.S. inflation prints.
I just don't think people are ready. I saw somebody say, "Are you ready emotionally for $100,000 Bitcoin?" I don't think people are. I really don't. I don't think they're ready to see the next bull cycle, which is as inevitable as spring turns to summer and night turns to day. It's going to happen. And all the fundamentals, back to fundamentals. I love fundamentals. Hash rate, all-time high. Number of wallets greater than 0.01, all-time high. You got the whole new thing on ordinals and things being and NFTs, on Bitcoin. Really hugely positive. And look, this goes to, are we going to live in a single chain world? Is Bitcoin going to be the chain to rule all chains? Are we going to be in a multi-chain world with bridges and interoperability? I don't know. I still don't know the answer to that. But I think that the inevitability of digital assets is stronger than it's ever been. The positive energy around the ecosystem is starting to come back after being suppressed. And look, are they going to try to beat it out of us more? 100%. There's more bad stuff coming from our buddies in Washington.
Bitcoin has been considered a market mover since the inception of cryptocurrency. Despite different bull or bear cycles and government regulations, Bitcoin continues to stand the test of time. Now that there is growing momentum in Bitcoin's price in 2023, crypto traders and experts predict that Bitcoin can record a new all-time high in the coming months. Bitcoin halving is due next year, 2024, which helps curb inflation and maintain scarcity, thus increasing its demand and value. Despite rising situations that could make or mar its price, Bitcoin's market dominance cannot be overemphasized. Do you expect U.S. market to perform better in the coming days? Let us know in the comment section below. If you like our content, give this video a big thumbs up and do subscribe to our channel.